As Bitcoin stocks cheer U.S. inflation slowdown, one macro expert calls for caution. Slower inflation often portends a decline in corporate profitability, and that is yet to be priced in by risk assets. Analysis by Steno Research's Andreas Steno-Larsen shows. While Bitcoin and stocks are cheering Tuesday's softer than expected U.S. Consumer Price Index (CPI) print, one expert suggests slowing inflation is not a reason to buy risk assets. The CPI was 7.1% on an annual basis in November, slower than a Refinitiv consensus estimate of 7.3% and down from October's 7.7% reading. Core inflation, which strips the volatile food and energy components, dropped to 6.0% from 6.3% the month before. The data, which strengthen expectations for a slowdown in the Federal Reserve's interest rate increase path and a pivot to liquidity easing in second half 2023, lifted risk assets. Bitcoin jumped over 3% to $18,000 following the CPI release, the highest since November 10, CoinDesk data show. The S&P 500 gained 0.7%, while the dollar index dropped to a 6-month low. Optimism stemming from an assumption that once the Fed turns dovish, institutions will again have access to cheaper money may be premature. However, slower inflation often portends a decline in earnings per share, EPS, a barometer of corporate profitability. And that usually weighs on stocks and zaps overall risk appetite in financial markets. Bitcoin has moved in lockstep with equities since last year. Those who find a lower inflation print a good opportunity to buy risk assets should look away now. Andreas Steno-Larsen, founder and CEO. Follow the URL for the full article. For more on this story, visit the news article link.